In today's video, we're going to explore the biggest mistakes traders often make and the best ways to prevent them. But before we dive in, if you find this video useful, make sure to hit that like button. And if you're new to the channel, remember to subscribe and enable notifications so you never miss our newest uploads. I'll catch you right after the intro and disclaimer. Mistake number 1. Overtrading. Many beginner traders, lacking proper price action analysis, start taking random trades as soon as the market opens, which leads to losses. In an effort to recover these losses, they skip forming a solid setup on the chart and enter trades impulsively, increasing their losses even more. Such continuous losses can make traders frustrated or depressed, causing them to repeat the same errors the next day. That's why you should never chase the market. If you face a loss on any given day, accepting a small loss and stopping trading for that day is the first step toward becoming a consistently profitable trader. Mistake number 2. Fear of loss. On this chart, you analyze the price at a certain level and decide to enter a long position. After some time, the price reaches your planned entry point as per your analysis, but you hesitate to enter, fearing a potential loss. Later, the price moves in your predicted direction and starts rising while you simply watch. Eventually, seeing the price continue upward, you jump into the trade at a higher level than planned. Without proper consideration, the price moves slightly higher, then reverses, resulting in a much larger stop loss than intended. This triggers panic, and you exit the trade during a minor correction. As soon as you exit, the price resumes moving in your direction and hits your profit target. This is a common situation for many traders. When the price reaches your analyzed entry level, you must enter the trade confidently. Setting a stop loss will ensure your losses remain controlled. Mistake number 3. Exiting winning trades. Whenever you take a trade after proper price action analysis, your stop loss and profit target should be clearly defined in advance. You should not close the trade until either one of them is triggered. Many beginner traders hold on to losing trades for too long without setting a stop loss. Yet, when a trade starts showing a small profit, they quickly book that minor gain without maintaining a proper risk-to-reward ratio, completely disrupting their risk management. Once you've entered a trade, avoid exiting your full position until you achieve at least a 1-to-2 risk-to-reward ratio. You can, however, secure partial profits by using a trailing stop loss. Trading mistake number 4. Trend buyer's entry. Some traders decide even before the market opens that they'll only take bullish trades for the day. But when the market opens and bearish price action appears on the chart, these new traders still take call side positions without analyzing the setup properly, resulting in repeated stop loss hits. Over time, this leads to frustration, and they start blaming the market instead of their own approach. Therefore, if you trade intraday options, while you can anticipate market direction to some degree, most of the time you'll need to stay neutral by taking trades aligned with the setups created by price action on the chart. Your stop loss will get triggered less frequently. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Trading mistake number 5. Lack of patience. Impatience is one of the most common mistakes in trading, leading to heavy losses and missed opportunities. Having patience means waiting for favorable market conditions and acting only when the setup is right. You must wait for proper setups and confirmations so your trades are logical and well calculated, not emotional or impulsive. When traders lack patience, they enter or exit positions too early, often going against their own trading plan, out of greed for higher profits. Some increase their risk without proper analysis, which can lead to damaging results. For instance, here the market remains in a consolidation zone with green and red candles forming continuously. Yet many traders, driven by greed, jump into trades without confirmation or clear price action, causing their stop loss to trigger and resulting in losses. To avoid this, remember these 3 essential rules of trading. Trading plan. Create a strong trading plan with well-defined entry and exit points. Follow it strictly and avoid emotional decisions. Risk management. Always use proper risk management tools, like stop-loss orders, for every trade. This limits potential losses. Continuous learning. Keep learning about the market and refining your strategies. Ongoing education is key to long-term success. Mistake number 6. No stop loss. This is one of the most important mistakes to avoid. Many traders fail to set a stop loss when entering a trade. Instead, they rely on manually exiting trades by just observing the charts, but no trader should ever do this. Maintaining discipline is essential in trading. That's why you should always place a stop loss directly in your trading platform. Sometimes, the market may not move in your favor, resulting in growing losses. Still, hoping the market will reverse, you hold on to the trade, allowing the loss to increase further. By the time you realize the market won't turn in your direction, it's already too late, and you face a major loss. Therefore, always ensure that a stop loss is set whenever you open a position. Mistake number 7. Large capital and big lot sizing. Many new traders, who are still learning and lack proper knowledge of price action, begin trading with big capital amounts and large lot sizes right from the start. They may earn profits for the first few months, but when losses eventually appear, the situation changes quickly. Huge losses start to eat away at their capital, and over time, it steadily declines. That's why, when you're still in the learning phase, you must keep your trading capital small. Always trade with minimal risk, use just 1 or 2 lots at most. That's all for today. Thanks for watching. There are 2 types of people, those who only wish, and those who take action. If this video motivated you to take action, make sure to hit that like button. And if you're new here, don't forget to subscribe and turn on the notification bell, because the next video will move you 1 step closer to success. Remember, the only limits that exist are the ones you choose to accept. Stay strong, stay consistent, and keep moving forward. I'll catch you in the next video.